Good morning, everyone. I am CA Shruti Gupta, moderator for 27th Valuation Manthan session,
Recording in progress.
Valuation of employee stock options and liquidation preferences using option pricing model organized by Valuation Standard Board of ICAI. We are delighted to welcome you to an enriching journey through valuation expertise. Let us start today's session by welcoming the Honorable Vice Chairperson of the Board. We have with us CA Preeti Paras Ma'am. I invite her for her opening remarks. Ma'am is a Central Council member and Vice Chairperson of Valuation Standard Board. Ma'am, please share words of wisdom with us.
Hello, good morning everyone, and welcome all of you to this session on Sunday morning Valuation Manthan. And today, as rightly said by Shruti, we have the session on the valuation of ESOPs. And we have with us Amrishi. So welcome Amrishi. And he will, with his experience, he will take us through the journey of the valuation of the ESOPs and the details which were liquidation preference using option pricing models. So this is today's topic. And friends, as we have already shared with all of you that we have also received the recognition as a entity valuation triple IPICAI for the plant and machinery and land and building also. And very soon we'll be coming out with the standards of those also, and which will be in line with the international standards. And we are in touch with IBBI and the regulators.
संडे ना थे मम्मी
So I was again this valuation Manthan series has got very good response, and I request office to put all these sessions on video mode online, so anyone can see at any point of time. We have ICI TV also. I have received various requests from various members and the valuers that they should be there online available at any point of time. So I request office to please ensure that this all these sessions are there online on our ICI TV channel. And with this opening remarks, I wish you a very happy learning on this Sunday morning. And stay in touch. If you have any suggestions on any of the topic or any sessions, please feel free to connect to Chairman Hansraj Paichuk or myself at any point of time. The office is also taking care of various things in relation to the valuation. So stay in touch. And today our session chair, our board chairman is also busy at some in some another event, and I am aware that he is in FRRB training program, and hence he is not able to join. However, on his behalf and on behalf and on myself and on behalf of Valuation Standard Board, once again I welcome all of you. Over to Shruti.
Thank you so much, ma'am. Thank you so much for guiding us in the right direction. So before we start, I just want to let you know that we have a question domain to source your questions. And today we will be taking questions in two parts since we are covering two different topics. So let us start with the session today. And I'm very delighted to welcome our speaker for the day, CA Amrish Garg. Thank you, sir, for gracing us with your presence. Sir is a CFA, a chartered accountant with All India's 6th rank in final examination and a BCom honors from SRCC. You have a 14 plus years of experience in business valuation, purchase price allocation, complex instrument valuations, fundraising, and transaction support services. Your experience spreads all across sectors such as enterprise, FAAS, tech startups, FMCG, retail, food and agriculture, specialized manufacturing, logistics, etc. You are a registered valuer under the provisions of Section 247 of Companies Act 2013. Your articles on valuations are published on the ICAI Journal. You are an eminent speaker, having delivered lectures on valuations and related topics at various summits and events organized by the Registered Valuer Organization, MBA institutes, study circles, corporates. Thank you so much, sir, for gracing us with your presence. We are all eager to learn from you. Over to you, sir.
Thank you, Shruti. Good morning, everyone. First of all, thanks to ICA Valuation Standard Board for giving me an opportunity. Thanks for Preeti ji for your opening remark. And so we look forward to have a very interacting session today. So I'm going to share my experience of doing valuation of ESOPs and liquidation preferences using option pricing model. And so we will keep this session interactive, as Shruti has suggested that we'll keep the Q&A in two parts. So as soon as we are done with the ESOP valuation, we can take your queries and then we can move to the second topic. So though these are two different topics, but they are interrelated. So therefore we thought to merge both the topic in this presentation. So I'll start the presentation by sharing my screen. Just give me a minute, I'll share my screen. Yeah. So I hope my screen would be visible.
Yes.
Yes.
Thank you. Great. So we will first start with the valuation of employee stock options, and in last few years you would have seen in India the word ESOP and employee stock option, it became quite prevalent, especially with the emergence of startup ecosystem in India, because many startups they started giving employee stock options to the employees to motivate them. Though this
Sir,
the
I'm so sorry to interrupt you. Sir, can you use the slideshow mode? The screen is not visible. The slide is not visible. Yes.
Is it better?
Thank you so much, sir. Yes,
Okay.
sir. Thank you.
Yeah, just sure. So basically, you would have heard a lot about now employee stock options, and they're quite commonly being given to the employees. So first of all, we'll understand what exactly is employee stock option and what's the purpose of issuing ESOPs. So if we go to the definition of employee stock option, it's a right which is given to certain employees to acquire the shares of the company. So whenever the ESOPs are granted to the employees, they ultimately get a right that based upon the certain terms and condition defined for the employee stock defined under the employee stock option plan, that they can acquire the equity share of the company at certain price on certain date. So therefore, the key things in employee stock option is that, first of all, it's a right. So on the date of grant, the employee do not get the equity share. The employee get a right to get the equity share. So this is one important thing, that employee stock option is a right in the hand of employee. Second, in case of ESOP, the price at which the employee could acquire those shares are predetermined, which is known as exercise price. So we are going to discuss about different terms in the subsequent slide. But at this stage, it's important to understand within the definition of ESOP is that the price at which the employee could exercise or buy those equity shares of the company is predetermined. So, and that is known as exercise price. And then third key factor is that there are certain vesting conditions which are defined within the ESOP plan, which talks about that how the shares are going to vest to them, when they could exercise those shares. So all those terms and conditions are given, and now there are certain conditions also attached to vesting, such as there should be certain performance benchmark for the employee, for the company. So there could be multiple conditions attached to the vesting. But broadly, these are the three critical points associated with this. So that, first of all, it's a right. Second, the right is to get the underlying equity share at a predetermined price within certain vesting conditions. So this is the employee stock option definition. Now, coming on broadly, like why ESOPs have been so prevalent right now, and what's the benefit of issuing ESOP? So one of the major benefit is that it helps employees to motivate and enables tech companies, especially if I talk about, because this is more common in case of tech companies, is to align the employees' vision with the company vision. So by giving ESOPs to employees, somewhere the top management is able to associate employees' vision with the company vision and make them motivate and align themselves with the company vision. So the employee feel like they are also the owner. So by having some equity stake into the company through ESOPs, the employee feel that they are also a partial owner in the company. So their motivation level, their commitment, their responsibility basically increases a lot. So therefore, ESOP has been used as a very good instrument to motivate employees, to compensate them, to encourage them. And in past, we have seen in case of companies like Flipkart, Zomato, and other large large tech companies and similar kind of startups where employees made huge money whenever the companies came up with a buyback of their ESOPs. So whenever those companies got listed or those companies were bought out and the ESOPs got monetized, so the employees made good fortune. So therefore, it used as a very good tool to motivate the employees. So this is just to set a background about ESOPs and the benefit of ESOPs. Now moving to the next slide, which talks about the various terms which is being used within the ESOPs. And understanding of these terms is very important when we deep dive into the valuation. So to conduct a valuation of any employee stock option, it's first of all very important to understand what's the grant date, what's the vesting period, exercise price, spot price. So understanding of each term is very critical, and understanding that when a valuation is required, because in case of ESOPs, different valuation is required at different point of time under different statute. So I'm going to discuss that part along with these terms. So the first term under employee stock option is called the grant. So grant means that this is the granting of a right to acquire the shares to the employees. So basically the date on which any ESOP is granted to the employee is called the grant date. So the grant means giving ESOPs to the employee or offering ESOPs to the employee, and the date on which the ESOPs are granted is called the grant date. So the grant date doesn't mean that on that day employee become a owner of the equity share. The employee become a owner of the employee stock option. It means that on that date employee get a right to acquire the share subject to certain conditions. So therefore, the grant date is the date on which ESOPs are granted. After the grant date, it comes the vesting period. So what happened is that within the employee stock option, there are certain vesting schedules. So for example, in the ESOP plan or the grant letter, it could be written that the employee is entitled to receive 100 equity shares of the company over a period of 4 years with a 25% vesting schedule every year. So it means that out of those 100 shares, 25 shares will get vested annually for next 4 years. So at the end of year 1, the employee could exercise 25 shares or exercise its right to get the 25 shares. At the end of year 2, additional 25. At the end of year 3, additional 25. And by the end of year 4, all 100 he could acquire or exercise the right to acquire those shares. So therefore, vesting schedule or vesting period is the period on which the employee could exercise the right to acquire the shares. So on the grant date, what happened is that they get the ESOP document. Within the ESOP document, the certain conditions are written, and then on the vesting period is the date on which he can actually exercise his right to acquire those shares. Now, after the vesting period comes the exercise period. So what is the exercise period? So once the right to acquire the shares right has been started, then certain period is given to the employee to decide whether they want to acquire the shares immediately or they would like to wait for a certain period of time. So the period from the vesting date to the ultimate date on which the employee exercise those shares are called the exercise period. So during this period, the employee could take a decision to purchase those or to acquire those equity shares. So therefore, these are the 3 critical dates which we need to understand. So what first is grant date, second is vesting date, and third is the exercise date. Now, the valuation requirement under different statutes is different on each date. So if we talk about the grant date, so under accounting standards, especially Ind AS, the valuation of employee stock option is required on the grant date. So on the grant date itself, the company is required to value their employee stock option and to work out the corresponding employee compensation and record it into their P&L based on the vesting schedule. So therefore, from a financial reporting perspective, the valuation is required on the grant date. Generally in India, the exercise price is kept at 10 rupees, or the face value of equity share. So therefore, the companies do not ask valuers to perform any valuation of equity shares on the grant date. But there are certain companies where they like to keep the exercise price equivalent to the fair value of the equity share, underlying equity share. And this is a requirement under US also, under their income tax laws, which is called as 409A regulation under the in US. So in US, if the company is issuing any stock option to the employees, then they need to keep the exercise price equal to the fair value of the underlying equity share. So therefore, at the time of grant itself, a valuation is being performed to determine the equity share of the to determine the fair value of the underlying equity share, so that the exercise price could be determined, and the exercise price is equal to the fair value of the underlying equity share. But in India, generally, like in our experience, in majority cases, the company keep exercise price as 10 rupees. So therefore, to calculate the equity share value, we do not conduct any valuation, and we perform the valuation only for employee stock option for the financial reporting purpose under Ind AS. This on the grant date. And on the grant date, no valuation under Income Tax Act is required. Coming on the vesting period, on the vesting date, once the employee effectively get a right to exercise or to acquire the shares, then no valuation is required under any statute. Now, coming on the exercise date. So on the exercise date, when the employee actually buy those shares, since there could be a certain delta between the fair value of the company on the date on which the employee acquire those shares and the exercise price. So there could be a situation that on the exercise date, the fair value of the company could be, say, 100 rupees, and employee could acquire those shares at 10 rupees because the exercise price was 10 rupees. So therefore, 90 rupees has become a gain for the employee, and that gain is taxable in the hand of employee on the date of exercise itself. So from that perspective, a valuation is required under Income Tax Act, where we need to determine the fair value of equity share, not the fair value of stock option, the fair value of equity share, so that the gain in the hand of employee could be calculated. And then there's an obligation on the company to deduct the TDS on that gain amount. So therefore, on the exercise date, the valuation of equity shares is required, and that valuation is conducted by a merchant banker, because under Income Tax Act, the merchant banker is authorized to perform the valuation for the purpose of ESOP on the date of exercise. So these are the valuation requirement under different statute on different dates. And right now we are performing a lot of valuation for startups and for other companies, listed companies, or the large groups where the stock option have been granted, and we are performing those valuation on the grant date. Now here there's also one situation comes, and that situation primarily comes again in case of tech companies, where the companies, they are issuing stock option to the employees almost on monthly basis. So every month there are certain stock option granted to the employees, either to existing employees or to new joinees. I'm sure now the question would come in your mind that whether the valuation is required on each grant date. So it means that whether the valuation is required on monthly basis. Technically, yes, the valuation is required on each grant date. So therefore, every month the valuation would be required. But there we take a practical view. So there what we generally do, depending upon situation to situation, but I'm giving you a practical view which you can also consider while performing any valuation, is that what we do, we bucket the grants into 4 quarterly periods. So instead of doing valuation on each grant date or on monthly basis, which could be quite cumbersome process, what we do in discussion with auditors is that we bucket the valuation into 4 quarters, and we just issue reports on a quarterly basis. So for example, we issue first report, which is, for example, April 1, 2023. So that report is basically applicable for any grants which happen during the quarter of April to June 2023. So any grants which are happened during this period, the accounting is done based upon the value which we have given on April 1, 2023. Then we will again perform valuation on July 1 for stock options, and then ESOPs which are granted those period will be considered based upon July 1 valuation, accordingly on October 1 and then January 1. So this is how we practically cater the situation where there are multiple grant dates spread over a period of 1 year. But there are few, I would say, disclaimers there. If the exercise period or the exercise price is quite closer to the spot price, then doing this bucketing may not be the perfect idea. So this is mainly applicable in a situation where there's a significant delta between the exercise price and the spot price, where the exercise price is just 10 rupees, but the spot price is significantly high. It could be 10,000, it could be 20,000. So there, since the delta between exercise price and the spot price is quite high, the other inputs, for example, time to maturity, risk-free rate, volatility factor, does not have a significant impact on the value of stock option, which we are going to discuss when we are going to discuss each inputs. So therefore, in those situations, taking the shortcut of doing valuation on quarterly basis instead of monthly basis or over a period of time or on each grant date could work. But so you need to really understand the situation and see and run the sensitivity analysis, whether performing valuation on a quarterly basis versus on each grant date, does the result vary significantly? If the result varies significantly, then we should follow what's technically written under the guidelines that we have to do perform valuation on grant date. But if there's no major sensitivity and the result does not vary a lot, then I think one could follow a shortcut or practical view of valuing the stock options on a quarterly basis for Ind AS purpose. So this is broadly like on the valuation requirement on the dates. Now the other terms which are used is called exercise price and the lock-in period. So exercise price is basically the price at which the employee could acquire those shares, and lock-in period is that. So generally within the stock option plan, there could be a condition that once the employee acquire those shares, the employee could not sell those shares for a certain period of time. So therefore, there could be a lock-in period situation under the terms. So this is broadly about the key terms. I hope I was able to explain each terms in a detailed manner. We can again take any query if there are any at the end of this session. So now coming on the specific requirement under Ind AS, because as I told you from our practical experience, the most of the requirement of valuation is to comply with the financial reporting requirement under Ind AS. So therefore, it's important to understand the provision of Ind AS and why the stock option valuation is required. So Ind AS 1 or 2 grants it has the relevant provisions in relation to the share-based payments, and this is the relevant Ind AS which captures the provision relating to the stock option and their accounting. So within Ind AS, it talks about that. So what's the objective of Ind AS 102 is to specify the financial reporting by entity when it undertakes a share-based payment transaction. So any transaction in which the company offers its shares as a mode of payment instead of cash or other asset, it offers shares as a mode of payment, and how to do the accounting for that share-based payment transaction, both in the balance sheet and the P&L of the company, is something which is gone through Ind AS 102. Now, so Ind AS 102, what it says that the date on which the company enter into any contract in which it agrees to receive certain services and offer the shares in return for those services, the accounting needs to be done in the books of account, or the compensation or the charge against that services need to be recorded in the P&L account. Now, what happened is that in case of employees, since the value of their services, like what's the value of their services, the date on which the contract is being entered is not known. So therefore, as a substitute, the option which are granted to them is being valued. So the fair value of option is taken as a proxy for the fair value of the compensation of the employees for which these options are granted. So therefore, in this case, like the objective of Ind AS 102 is to record the fair value of compensation or fair value of services, fair value of product, whatever is being acquired under the share-based payment transaction. But in case of employees, since the fair value of compensation cannot be calculated with accuracy, as a proxy, we calculate the fair value of the option which are granted to them, and that fair value of option is taken as a proxy for the fair value of compensation, which is then recorded in the P&L account over the period of vesting schedule or whatever the conditions defined within Ind AS. So this is the purpose of doing ESOP valuation. The settlement, the share-based settlement could be of two things. One is the equity settled, and second could be the cash settled share-based payment. So what it means that on the exercise date, there could be two situations. One situation, the company could say that the employee could get the equity shares of the company, and then they will become an equity owner of the company. So that is called equity settled. There could be another situation where the company will, the company says that the stock option will be settled in cash. It means that on the exercise date on which employee exercises its right to acquire the shares will not be granted to the employees. Rather, the cash will be paid to the employees and the cash will be calculated as a delta between the spot price and the exercise price. So just to give an example, on the date of exercise, if the fair value of the company is 100 rupees and the exercise price is 10 rupees, so the company will pay 90 rupees to the employee because it's a cash-based, share-based payment. So the employee will get a benefit of 90 rupees. In an equity settled, what happens is that the employee will get equity shares which is worth 100 rupees by paying 10 rupees. But in case of cash settled, the employee will get will get 90 rupees cash, and the employee will not get equity share upon the exercise date. So this is broadly the difference between equity settled and cash settled, and depending upon the nature of share-based payment, if the accounting is required. So for example, in case of equity settled, the accounting is only required on the grant date. But in case of cash settled, the accounting is also required on each reporting date. So which means that on each reporting date, the company needs to fair value its stock options and record the liability on its balance sheet. So why such kind of difference? So I'll explain you logically. So what happened is that now if the transaction is an equity settled share-based payment, and the exercise price is 10 rupees. So assuming the company has granted shares in the month of April 2023, and at that point of time, the equity value of the company was say 50 rupees, and they have granted stock options at 10 rupees of exercise price. So whatever is the value, broadly, hypothetically saying, say the value of stock option was 40 rupees. I'm using a very general statement saying 40 rupees because 40 may not be a right value, but I'm just for this purpose, I'm saying that assuming the fair value of the stock option is 40 rupees, then the company will do accounting using that 40 rupees as a compensation for that employee over the period of vesting period in the P&L. So 40 rupees, assuming if the vesting is say within 1 year itself by the or assuming vesting is over a period of 2 years, then 20 rupees will be charged this year and balance 20 will be charged to P&L next year broadly. Now what happened is that, so this is the equity settled, and no treatment will happen on the reporting date. Now come to a situation where it's a cash settled, and on 31st March, the value of the underlying stock has increased from 50 rupees to 100 rupees. Now, what happened in case of cash settled, since it's a liability of the company to repay the delta between the stock price and the exercise price. So therefore, it's important for the company to recognize any increase in the value of stock option because the liability of the company has also increased. So therefore, if the stock price has increased from 50 to 100, and now the overall delta is now 90 rupees between the exercise price and spot price, and the company would be liable to pay this 90 to the employee on the exercise date. So therefore, in the case of cash settled, it's important to recognize that liability in the balance sheet of the company. While in case of equity settled, since the number of shares has already been decided and the company has already recorded that transaction on the grant date, any increase in value of the shares will not impact the balance sheet of the company. It will not increase any liability of the company in case of equity settled, but in case of cash settled, any increase in the stock price directly increase the value of the directly increase the liability of the company. So therefore, in case of cash settled, it's important to do the valuation on the reporting date also on 31st March or whatever is the year end for the company. So this is broadly under Ind AS that what's the regulation, and I have covered broad terms from a valuation perspective. I didn't deep dive into the accounting perspective because that is not the valuer's task. Our task is to perform the valuation. So therefore, I have broadly discussed about the valuation provision within Ind AS. Now, before we deep dive into the valuation of stock options, I'd like to first discuss about the options with you, because there could be few participants who might not be aware about how the options work, what are the characteristics of options. So therefore, it's important to first understand options, and then we'll deep dive into that how to value the stock option using different option pricing models. It could be Black-Scholes model, it could be binomial model. So let's first understand the options. So option is a derivative contract under which the holder has a right to buy or sell a specified quantity of certain assets at a fixed price on or before the expiration date. So these are the key points or key terms used in the definition. So first of all, it's a derivative contract. Second, in this case, the holder gets a right, and the right could be buy or sell. And what is the right? The right is to get a specified quantity of certain underlying asset at a fixed price on or before the expiration date. So these are the characteristics of an option where the holder gets a right to acquire certain thing with a specified quantity at a fixed price before expiration date. So this I'm talking about a plain vanilla option. There could be many exotic options where some of the terms could not be defined, where the quantity could not be defined, where the exercise price could not be defined, and those prices are linked to certain future events, future things. But here this definition, I'm talking about a plain vanilla options. So therefore, the important characteristic is that it's a right, it's a right, and it is not an obligation. So the holder may decide to exercise or not to exercise its right. So if it is not beneficial for the holder to exercise the right, then the holder may deny not to acquire the share. So for example, if the employee has a right to acquire the stock to acquire the underlying equity shares at rupees 50, and on the exercise date, the underlying equity value of the company was at 30 rupees. So it is not beneficial for the employee to exercise this right, because the employee has to pay 50 rupees to acquire a share which is worth 30 on that day. So therefore, the employee will not exercise its right, and the stock option will be lapsed. So therefore, it's a right. But if on that day the equity share value is say 70 rupees, then it's a beneficial for the employee to exercise its right, because by paying 50 rupees, the employee will get a equity share which is worth 70 rupees. So it's a beneficial for employee to exercise its right. So therefore, option is a right, not an obligation. Now the option could be of two types. One is a European and second is American, and it's very important to understand this part before applying any formula, any model for stock option valuation. So European option means that the underlying holder of that option could exercise it only on a specific date. So for example, in the European option, it is mentioned that on a specific date, the holder could exercise its right. And if the right is not exercised on that date, it will lapse. So the document will basically say that, I'll take hypothetical figures so that you can understand this. The stock option grant letter or the plan could say that the grant date is assuming April 1, 2023. And the employee could exercise its right on 31st March 2025. So if it is written that the right could exercise only on 31st March 2025, then it become a European option. But if the grant letter says that starting from April 1, 2023 up to 31st March 2025, anytime the employee could exercise its right, then it become an American option. So within American option, the right could be exercised anytime on or before the expiration date. So therefore, in the case of American option, the right could be exercised maybe on June 2023. It could be exercised July 2023. So it could be exercised any day between this two period, between April 1, 2023 and 31st March 2025. So therefore, whenever we are doing any stock option valuation, ESOP valuation, first of all, we need to understand whether it's a equity settled and cash settled, because accordingly we need to decide the dates on which valuation is required. And then depending on the terms, we need to first of all understand that whether it's a European option or it's an American option. So we have to see that what the term says, that whether the employee could exercise only on a specific date or whether it could exercise over a period of time. Because the selection of method really depends upon the style of this of the option. Now, after understanding the definition of option, it's important to understand that what are call option and put option, and what's the nature of employee stock option. So in case of call option, the holder gets a right to buy the shares. In case of put option, the holder gets a right to sell the equity shares. So therefore, employee stock options falls within the category of call option, because in case of employee stock option, the employee get a right to buy the equity share of a company, and therefore ESOPs are valuing using the call option valuation method. So whatever the valuation method which is determined, or the formula applicable for the call option is the formula which is used for the valuation of an employee stock option. Now, after understanding the option, now we'll move forward to discuss about the methodologies which are generally used for the valuation of employee stock options. So there are two quite commonly used method. One is called Black-Scholes method and another is called binomial model. And sometimes Monte Carlo is also used, but this is in a very rare situation where the underlying terms and conditions of the stock options are very complex. There the Monte Carlo simulation is used, and this is mainly used in case of a stock appreciation right. So there's another rights which are granted to the employees, which are called stock option appreciation rights, which is not very prevalent in India, but they're quite prevalent in the developed markets like US, where the right or the incentive of the employee is linked to the stock performance of the underlying equity share of the company. So if there's a certain increase in the value of the stock option or the performance of the company, then that increase is shared with the employees through stock appreciation rights. So, but those are very complex instruments. We generally don't see such kind of instruments in India. So therefore, as part of this presentation, we are primarily going to focus on the Black-Scholes model and the binomial model. And in majority cases, the Black-Scholes model is being applied. BS model is applied to calculate the value of stock option. So I was interacting to one of the team member of a company called ESOP Direct. So this is one of the agency in India who helps a lot of companies in designing their ESOP plan. And there the person was saying that they conducted a survey, and during that survey it was found that in more than 90% cases the companies were employing BS model, the Black-Scholes model, for applying for calculating the employee stock option. So therefore this is the most prevalent model. So therefore we are first going to discuss about the Black-Scholes model. So this is like not only for employee stock option, worldwide this is one of the most common applied model for calculating the valuation of any options. And so certain overview about this model I have mentioned here, that it first got introduced in 1973, and but the most important part which need to understand here is that BS model is technically designed to value European style option, and this is the underlying assumption of BS model also, that the option is a European option, which means that it could be exercised only at a specific period of time. So therefore, any employee stock option which is not a European option, which is an American option, should be valued using binomial model. But there are a couple of catch here, and which we use as a practical tool. Technically, again, it may not be 100% correct, but since there's no significant difference between the outcome of binomial model and BS model, the situation which I'm going to discuss with you right now. So as a practical view, what we do, especially in case of startup companies, even though the term says that the employee could exercise it over a period of time, and it's an American option, but since in case of startup companies, there's no dividend payout, there's no history of dividend payout, and we know that in near future, the company is not going to pay dividend. We use Black-Scholes model as a proxy or instead of binomial model, because if the company is not a dividend paying company, then we could apply BS model as a substitute, even though it's an American option. And we use a specific way to calculate the time to maturity, which I'll discuss once we're going to discuss about the input for BS model. So that is one exception where I would say that we use BS model even if it's an American option. So where the company is not dividend paying company, in case of startups, and again the delta between exercise price and the spot price is significant. So therefore this could be used as a proxy, and one can use Black-Scholes model itself instead of binomial model in that situation. So this is the one thing. But if the company is a dividend paying company, and if the option is American option, then our suggestion is that technically we should use binomial model and not the BS model, because BS model is not technically designed for the same. Now, how to apply BS model? There are many, so I'm not going to deep dive into the formula for BS model, because there are many tools available online, Excel tools, where the formula for BS model is inbuilt. But to apply those formula, it's important to understand the key terms associated with the formula, so that then we can use those tools. And I'm going to present you those tools also right now. So therefore, the statistical formula for BS model I'm not covering, but I'm covering the input which is required. So for any BS model, there are 5 or 6 inputs which are required. The first is the strike price, or this is also called the exercise price, or this is the price at which strike. So there's some gap here. I'll fix. So strike price is basically the price at which the employee get the right to acquire those shares. So actually, while making this presentation, these two terms, exercise price and stock price, it got interchanged. But here, strike price is the exercise price, which means that the price at which the share could be purchased. And this we generally get through the employee scheme or the grant letter, and it is defined there. So this is the first input we required. Second input what we required is called the stock price, which means the fair value of the company on the date of grant, a fair value of the equity share of the company, or the fair value of the underlying share which the employee is going to get. So that we need to determine. And in case of valuation of employee stock option, this is one of the major input, where as a valuer we need to put lot of energies, lot of time and effort to arrive at this price, because exercise price is given in the contract. So in case of listed company, it's easy, because in case of listed company we can directly pick the market price. But in case of unlisted companies, we have to really calculate the value of equity share. So if the value of equity share is available, so if the management has already any valuation report available with them, where the valuation of equity share as of the valuation date is available, then we can pick that price. Otherwise, we have to perform a proper valuation by using different valuation methods to arrive at the equity value of the company. Then that equity value becomes an input for this PS model. So therefore, stock price is one of the most critical input, and where a lot of energies and efforts are being made. The third input is the time to maturity. So this is the period which determines that from the date of grant to the date of exercise, what is the time to maturity. So there are different ways to calculate the time to maturity, or not different ways. There's a I would say the understanding which is required. So assuming that if the grant date is April 1, 2023, so grant date is April 1, 2023, and 100 shares are being granted, which says that and the term says that the shares would vest over a period of 4 years, which with 25% every year. And once the shares are vested, then they could be exercised over a period of 5 years. Now, I'll again repeat the terms. Suppose the term says that the employee has a right to get 100 shares with a vesting schedule of 4 years, which means that 25% shares get vested every year. And once the shares are vested, then the employee has a right to exercise it over a period of next 5 years. So in this case, given these terms, how we will calculate the time to maturity, assuming it's American option and assuming it's a European option. Now, assuming if it's a European option, it means that the employee could exercise only at the end of year 5. So here the time to maturity will be on the date of grant. For the first tranche, which is the first 25% shares, the vesting period is 1 year, which is from the grant date to the vesting period, plus 5 years of exercise period. So therefore, the total time to maturity in this case would be of a 6 year. 1 year of vesting period, 5 years of exercise period, totaling to 6 years. For the second tranche of shares, for next 25%, the time to maturity would be 7 years, which is 2 years of vesting period, because the second tranche will vest after 2 years. So 2 years of vesting period plus 5 years of exercise period, then 7 will become the time to maturity. For third tranche, which get vest after 3 years, the time to maturity will be 8 years, which is 3 year vesting period, 5 year exercise period. It will become 8 years. And then for the last tranche, the time to maturity will be 9 years. So this is how, in case of European option, we'll calculate the time to maturity. Now, coming in case of an American option, where we are using Black-Scholes model as a shortcut to value that option, because assuming the company is not a dividend paying company. So what we do here, because the option could be exercised any time from vesting period to the exercise period, we take an average of the exercise period. So in this case, what will happen, the time to maturity, the way we calculate. So for tranche 1, 1 year of exercise period plus, 1 year of vesting period, I'll correct, 1 year of exercise period, 1 year of vesting period, 1 year of vesting period plus 2.5 years of exercise period. So therefore, the total time to maturity in this case will be 3.5 years. So I'll again repeat, 1 year of vesting period and 2.5 years of exercise period. How 2.5 years? Because the total exercise period was 5 years. We assume that since it could be exercised at any point of time between 5 years, we are taking average as a proxy for the exercise period. So therefore, total exercise period will be 3.5 years for tranche 1. For tranche 2, the total time to maturity will be 2 years of vesting period and 2.5 years of exercise period. So total will be 4.5 years. So therefore, for tranche 2, the time to maturity will be 4.5 years. In case of tranche 3, the time to maturity will be 3 years of vesting period plus 2.5 years of exercise period, which will make it 5.5 years. And for tranche 4, it will be 6.5 years. So this is how we calculate time to maturity depending upon the terms of option, whether it's American and European, taking the concept of vesting period and excess period. So this is again one important input into BS model, where we spend a lot of time to really understand the vesting schedule, understand the excess period, understand the nature of instrument, and how we are going to which method we are going to apply, and accordingly we'll calculate the time to maturity. The fourth input is called the volatility factor, vol. So for unlisted companies, generally we calculate the volatility of the share price of the comparable companies, and the vol we need to calculate the corresponding to the time to maturity. So if the time to maturity is 5 years, we need to calculate the vol for a corresponding period of 5 years for the underlying company itself. So if the underlying company is a listed company and we are picking the price, the listed price, will calculate the vol of that particular share itself for over a period of 5 years. But if it's a target company, is an unlisted company, we'll find out the comparable companies, and for those comparable companies, we'll basically then calculate the vol over a period of 5 years. So assuming if the time to maturity is 3 years, then we calculate the vol over a period of 3 years, historical 3-year period. And generally, so technically the implied volatility is used as an input, but for us it's difficult to find out the implied volatility. Therefore, we use the historical volatility as a proxy for the implied volatility in the BS model. So fourth input is vol. Fifth is the dividend. So if the company is a dividend paying company, then based on the historical trend, we estimate the future dividend yield, because in the BS model, we need to use the future dividend yield as an input, or we ask the management to provide that dividend yield. Then this is the fifth input, and the last input is the risk-free interest rate. This we generally take based on in India, we take based on the 10-year government bond or the zero coupon bond, depending upon whichever we are picking. Again, here the yield period should correspond to the period of time to maturity. So for example, if our time to maturity is 5 years, then we'll pick the yield for a 5-year government bond. If the time to maturity is say 5 years, then we'll pick for 5 years. If it's 3 years, we'll pick for 3 years. If the time to maturity is 1 year, we'll pick the risk-free rate for 1-year government bond. So therefore, the time period for the risk-free interest rate should correspond with the time to maturity. So these are the inputs which we generally which are required to apply a BS model. Using this input, then we put into a BS model and we calculate the output. And so you could find Excel files or their fintools.com. So I'll show you. So I'll give you an example. So this is how, like in our Excel, we have structured it, where we put this input of stock price, exercise price, the exercise period, the risk-free rate, and the vol. This is a formula which is embedded in the Excel, and we get the value of call option, which is 91.41. So basically, you can go online. So this is a website called FinTool and FinCalci. There also you get you basically get a calculator. You just need to put the formula here. And so here you get an option to apply BS model, binomial model. So this is for BS model. You can select the model you want, the underlying price. So if we pick this example where the stock price was 100, so we put 100 as a stock price. We put exercise as 10. Value date is, in this example, it's 31st March 2021. 31st March 2021. Expiration date is 3 years in this case. So this will become March 2024. March 31, 2024. Interest rate is 5%. Yield is 0. Vol is 50%. And then you calculate. Once you calculate, you get a value of call, which is like 91.41. Which is like here 91.41. So you can use this tool, or there's also Excel. So you can go to Damodran website. On Damodran website, he has tool for in Excel also for option pricing model. So this is how that I have an Excel file which I downloaded. This is how this look like. Again, you can put your inputs here, which I already did here in this case, like 100 as a. So this is the Excel file which is available on the Damodaran website. You can download this Excel file. You just put inputs here like stock price 100, vol 50%, exercise 10, expiration date, number of days, the risk-free rate. So what happened is that for BS model, we need to use the continuous compounding risk-free rate. So therefore, the risk-free rate which we get of any government bond is not a continuous compounding. So using that risk-free rate and the continuous compounding formula, one needs to convert into a continuous compounding. So using that input, ultimately you get a value of call, which is 91.41. So these are the like different tools which you can use to calculate the BS model or to calculate the value of option using BS model. So this is on the Black-Scholes model, which I told like is generally applicable in 90% cases, specifically for the European style stock option or where the company is not making any dividend payment. But as I told earlier, if the company is making dividend payment and it's an American option, then technically the right way to do it is to apply a binomial model. Again, you can find Excel files and tools to apply the binomial model. So what's the basic difference between BS model and binomial model is that in case of binomial, you basically just calculate the two future prices. So how exactly this option works, I'll maybe again take a couple of minutes to give you a further understanding, which I think I missed earlier when I was talking about option, is that how the value of option is being derived. So option of the value of option is a function of two things. One is the intrinsic value and second is the time value of money. So what does intrinsic value means is that, so like today, if you have a right to exercise or acquire any share at say 10 rupees and on the date of exercise, the price is 90. So this 90 rupees is basically the profit for you, which is the gain which you can have by holding this right. And if the price is say 5 rupees on the exercise date, then for you the gain or loss is zero because you are not going to exercise it. So therefore, what all this option pricing model do is that they calculate the future value of the underlying stock price on the exercise date and then calculate what is the payoff, what is the benefit or gain the holder could get it, and then calculate the present value of the gain to calculate the option premium. This is how broadly all these models work. So what happening? So take this example where the exercise price is 520. The value of the share on the date of grant is 500. Now on the exercise date, there could be two situations. The price could be 610 or the price could be 409. If the price is 610, then this is higher than the exercise period, which is beneficial for the holder, and there's a benefit of almost 90 rupees in this case, a gain of 90 rupees. So therefore, holder can exercise it and get a gain of 90 rupees. In this case, the holder will not exercise because this is below the exercise price and the payoff will be zero in this case. So the value today will be the weighted average. So what is the probability of getting this price? What is the probability of this price and the weighted average probability, assuming that the probability of getting both this price, assuming is say 50%. So therefore, there is a 50% probability that the holder could get 90 rupees benefit, which means that effectively the probability weighted gain is 45 rupees, which is like 50% of 90 rupees, or 45 rupees of gain, which the holder could get. And the present value of that 45 is basically the premium which the holder will be willing to pay today to acquire this right. So in binomial, we basically just work out the two prices, but in case of BS model, we work out the n number of prices. So the BS model is designed that on exercise date, it work out the number of potential prices here, and then the payoff and the present value of the same, which is basically captured in that formula. But in case when we apply binomial will just calculate the two prices, then we compare those price with the excess price, calculate the payoff, and then calculate the present value. But in case of binomial, we get the flexibility to factor in the dividend payments. And in case of American option, we can basically factor that on each node, whether it will be beneficial for the holder to exercise its right and enjoy the dividend rights, or to wait and wait for the increase in the price. So what happened is that how the dividend impacts the value of any option is that, so if the company is a dividend paying company, then by holding a stock option, the holder do not get the dividend benefit unless until they convert into underlying equity share. So therefore, if it's an American option and if it's a company is a dividend paying company, then the holder has two options on each date to decide whether they like to convert into equity share and start enjoying the dividend benefits, or should they wait and let the equity price to increase and then exercise it at a later date. So therefore, the binomial model allow us to factor this aspect where on each node we can decide whether it would be beneficial for it to exercise or not. So the impact of dividend is appropriately captured under the binomial model in case of American option. So therefore, technically, it's better to apply it. So this is broadly about binomial. Again, I'm not deep diving into the binomial calculations and everything, because again, you could find Excel tools and you could find online tools to basically calculate this decision tree and work out the valuation. So this is broadly on the valuation of stock options. I have covered the valuation dates, the critical terms which are there, the methods, the inputs. And now I'd like to open the discussion for audience, that if they have any queries on the employee stock option valuation, then we can discuss that part, and then we move to the second part, which is the valuation of liquidation preference, or to capture the impact of liquidation preference while doing the valuation of equity share. Because it's an interrelated topic, I'll explain how it's interrelated. But before deep dive into this thing, I'd like to first answer any questions if they are from the audience side. So Rahul and Shruti, I'll request if you could engage with the audience and see if they have any questions.
So should I take up some questions?
Yeah.
Just a second. So the first question is, what is the source one can use for the volatility and standard deviation assumptions?
So basically, you can calculate. So this is calculated based on the stock price, and generally we have our own Excel model defined where we take out the exercise price. We take out the share price. We take out the share price from BSE or other Yahoo Finance or other online tool, and using the formula of standard deviation, we calculate the volatility. So I would say you use your own Excel file, because here the volatility has to be calculated specifically correspond to the maturity period. So therefore, it's good to calculate yourself in the Excel file using the stock price of the listed company. So if it's a underlying company itself is a listed company, then you directly pick the market price. If the underlying company is an unlisted company, then you have to first of all calculate the comparable. You find out the comparable companies and use the price of comparable companies to calculate the volatility in your Excel file.
Thank you so much. The next question is, what is the difference between ESOP, ESAR, and RSU?
So ESOP is basically it's a standard term which is used for stock options, where any right is granted to them. The SARs, which is called stock appreciation rights, this is basically, as I told earlier, is more prevalent in the US market, where the vesting conditions or the terms is or the return is associated with the stock performance of the company. So generally it says that if there is a 20% increase in the underlying value of the company, then the employee will get X number of shares or X X value of their compensation. So in the stock appreciation right, it's primarily designed to what I would say, link with the stock performance of the company, and there are other vesting conditions which are associated there, so one has to really see what all conditions are there. So those are called stock appreciation right. And what's the other term, Shruti, you had said?
RSU. RSU.
Restrictive stock units. So restrictive stock units, again, I think it's a synonym for SARs. But I think the second term you use something.
So the question was, what is the difference between ESOP, ESAR, and RSU?
ESAR. Even I'm not sure what's the full form of ESAR. So that could be, I think ESAR could be used as a stock appreciation rights, employee stock appreciation rights, and then restrictive stock unit. RSUs are restrictive stock units. So again, these are the different terms which are being given depending upon what are the underlying terms and conditions. So RSUs are basically restrictive stock units, where the so sometimes the cash settle units are called RSUs. In our practical experience, we have seen. So
Okay.
about this
Thank you
term.
so much. So moving forward with the next question. Valuation required while reporting is on grant date or excise date?
Yeah, so under different statute, as I explained initially, under different statute, there is a different requirement. Especially for financial reporting purpose, the valuation is required on the grant date. And that too on the valuation for the employee stock option. So this is for the financial reporting purpose. For a corporate governance perspective, or for if someone is doing any work in the US market, for 409A regulation in US, then the valuation of the underlying equity share is required to fix the exercise price. Then the valuation could be required. But in India, it's only on the grant date what we are doing valuation for financial reporting purpose. Then on the exercise date, the valuation of underlying equity shares is required for income tax purpose to calculate the gain in the hand of employee and to calculate his taxability, because the company is required to deduct the TDS, and that valuation is conducted by the merchant banker. So these are the requirements.
Thank you so much. The next question is, that valuation of equity shares is required at the time of issue, even if the exercise price is equal to face value of equity share. Is that so?
Yes. So for the purpose of valuation of employee stock option, equity share price is one of the major input. So therefore, one has to calculate the valuation of equity share, even if the exercise price is equal to 10 rupees, or at face value, the equity share price or the fair value of underlying equity share is required for the BS model or the binomial model, because that is the starting point for our valuation.
Thank you so much. The next question is Ind AS 102 applicable to sweat equity as well?
I would say it's an accounting term. So it should be applicable, because ultimately any share-based compensation is covered through the Ind AS 102. But since I'm not an accounting expert, so I can't really answer this with surety. But as a concept, if I go logically, since it's any share-based payments are covered through 102, so sweat equity shares should also be covered through 102.
Moving forward, there's another question. In case of cash settlement, the cash compensation be taxed under the head salaries or will it be taxed as short-term capital gain?
Again, I would say it's a taxation question. So I may not be the right person to ask because see, our task is here to calculate the value. How the taxation and how the accounting is done is something which the management take care of it. So so I would defer this question.
So the next question is, how do we assume time until expiration in case the contract does not specify any exercise period? That is, employee can exercise any time after vesting.
See, generally, exercise period is defined in the contracts because the company do not keep it open-ended. But if the exercise period is not defined, so sometime what happen is that in some tech companies we have or startup companies we have seen this clause where they link the exercise period with the exit period of the investor or the exit period any exit event in the company. So it says that if this the employee has to exercise it before the occurrence of any exit event into the company, either through IPO, either through any M&A, or through any strategic sale. So in this case, then we discuss with management to understand that what's the potential exit event period they're looking into, like when they expect to have IPO, when they expect to have any strategic sale. And based upon that, then we fix the exercise period. So this is how we take a practical view when the exercise period is not defined properly.
Are there any reliable tools for Monte Carlo simulation?
Yeah, so there's a software called @risk, @risk, which is quite prevalent in the market, and you can touch base with them, and you can use it for MCS calculations. So it's @risk.
So there's one last question. Why interest rate is used in BS model? What is its relevance?
So basically, the underlying assumption under any option model is that the holder should get minimum the risk-free return on their underlying investment. So therefore, the risk-free rate of interest is being used in the option models, and in BS model. Since the price is calculated continuously over that period, and we use the continuous compounding interest rate and not the annual interest rate. So this is the main reason for using interest as a factor, because there's an underlying assumption that holder will minimum get a return which is equal to risk-free rate of interest.
Thank you so much, sir. So this is the end of first part of the questions. We can take up the questions after we cover up the second part.
Okay, great. I'll again present my screen. Now we can move to the second part of the presentation. Just a minute. Yeah, this is called, this is regarding liquidation preference. So nowadays, it's very important to understand this concept of liquidation preference, how it impacts valuation, what exactly liquidation preference means. And this you would find commonly in all the startup companies who have raised funds from investors. So as I mentioned you earlier, like if you go back here, I told you while applying, just give me a minute. Yeah. While applying BS model, the stock price, the underlying equity share of the company is one of the major input. And I told you that if the equity share price is not available, we need to calculate that equity share price for our valuation of BS model. So earlier what used to happen is that we apply DCF model, we apply comparable company method model, or we apply comparable transaction multiple method, we calculate the overall value of the company, divide by the total number of shares, we arrive at equity value per share and use it as an input in the BS model. This is generally what we do. But in case of tech companies, startup companies who have raised multiple rounds of funding, most of the investors, they invest in form of compulsory convertible preference shares, CCPS. And though those CCPS are also convertible into 1:1 equity conversion ratio, which means that one CCPS are convertible into one equity share, and on a fully diluted basis, it doesn't make any difference because CCPS is equivalent to equity share. And so one way to look into is to consider the fully diluted cap table of the company. So arrive at the overall value of the company, consider the fully diluted cap table, which means assuming CCPS as converted into equity share, and divide the total number of shares, including the CCPS, and arrive at the value per share of the equities. This is also many valuers were doing. But as we are getting more aware about different terms, different methods, one important aspect one has to consider between CCPS and equity share is the liquidation preference, right? So in case of tech companies, startup companies where investors, there are multiple VC investors, or if there's any institutional investors is there who has invested in form of CCPS, you will find in the shareholder agreement, there will be a clause called liquidation preference. So what that clause mean? So that clause says that in case of any liquidation event in the company, which include any liquidation of the company, which include any wind up of the company, which include even sale of the company, if any liquidation event happen in the company, so if the company, the investor exit through sale of the company, then the investor has a right to get its investment amount or the value of its stake into the company, whichever is higher, as the return. So I'm again saying that the liquidation preference clause says that the investor either will get its investment amount or its the value of its stake into the company, whichever is higher, as its return for its investment into the company. This clause make a difference, and now the CCPS and equity shares which are held by the promoter, or equity share which are held by other shareholders of the company, they are not at par. Even though the conversion ratio is 1:1, the value of CCPS is not equal to the value of equity share. Because of this liquidation preference right, CCPS is senior to the equity share, and therefore CCPS in terms of value term, even by having a 1:1 conversion ratio, the value of CCPS is more and the value of equity share is less. So therefore, we cannot simply use a fully diluted cap table of the company and just calculate the one price. In this case, we are going to overstate the value for equity share. We have to factor in the impact of liquidation preference on the value of equity share. By having this right, where the investor is saying that the investor could get its investment amount back. So there's a floor value attached to the investors' interest. So because of that floor value, the value of CCPS is more than the value of equity share, and we have to factor in that part. So assuming if the fully diluted, assuming that the company value is say 100 crore, and the value per share is say 1 lakh rupees per share, depending on the number of shares, on a fully diluted basis. But if we are going to capture the impact of liquidation preference, it could happen. The value of CCPS could be 1,10,000 and the equity share could be 90,000. This could be a situation, though the weighted average or the fully diluted value could be coming at 1 lakh rupees. But in this case, the value of equity share, after capturing the impact of liquidation preference on the equity share, the value could go down to 90,000 rupees. I'm just giving a hypothetical number. You'll see the impact once you go through the formula. So therefore, now in case of tech companies or any company where there are institutional investors who have invested in form of liquidation preference, and they have a liquidation preference rights, it's very important to factor in the liquidation preference rights impact on the valuation on the equity share, and then take that equity share price as an input into the BS model. So this is the liquidation preference rights, and there could be different category of liquidation preference rights. So therefore, when you read the shareholder agreement, you need to work out whether it's a participating liquidation preference right, whether it's a non-participating liquidation preference rights, what are the conversion rights, and again, liquidation preference could be of multiple times of the investment. So first of all, what's the difference between participating and non-participating? So in case of a participating liquidation preference right, basically the investor says that in case of any liquidation event, first the investment amount will be distributed to the investors, and whatever value is left, then investor is going to participate in the proportion of their shareholding pattern. So I'll take an example here. Assuming investor invested 20 crore into the company for a 20% stake. So 20 crore investment with a 20% stake means that the company is valued at 100 crore post money. Okay, so this is on the first date of investment. Now, say after 5 years, the company sold for a value of say 200. Okay. Now, if the investor is a participating investor, so what the investor says that out of this 200, first my 20 crore will be repaid. Okay. After repaying the 20 crore, 180 crore are left. Now, an investor have a 20% stake. So 180 into 20%, additional 36 crore will be repaid to the investor. So total return to the investor will be 56 crore, which is 20 crore of its investment amount plus 36 crore of its proportionate value of its proportionate interest into the company. So out of that 200, 56 crore would be paid to the investor. Assuming if this participating clause won't be there, then the investor would was entitled only to 40 crore, and the balance 160 crore was for the common shareholders. But by having this participating clause, now you see that ultimately the instead of 160 crore, common shareholders they are going to get 144 crore, and the CCPS holder investor is going to get the 56 crore. So this is the delta by having this participating liquidation preference clause into the shareholder agreement. And despite, like, even if the conversion ratio is 1:1, the value of common share and preference share were not at same ground. So therefore, it was important to capture the impact of this liquidation preference. So this is the participative liquidation preference. Now the non-participative liquidation preference. So what happens in case of non-participative liquidation preference? The clause says that the investor will get investment amount or the value for its proportionate interest, whichever is higher. This clause is called non-participative. So how this clause works? So again, based on the previous example where investor invested 20 crore for 20% stake, overall value of the company is 100 crore. Now I'll take two scenarios here. The first scenario where the company was sold for say 200 crore. In this case, the investor is entitled to 20% of 200, which is 40 crore, or its investment amount, whichever is higher. In this case, since the 40 crore is higher, investor will get 40 crore and common shareholder will get 160 crore. Okay. So in this case, you will say that non-participative liquidation preference has no impact. Definitely, if there is an increase in value, it has no impact. Now, take a situation where the value of the company was just 50 crore on the sale of the sale. In this case, now since the value is 50 crore, the investor will get 20% of 50 crore, which is 10 crore, or 20 crore, whichever is higher. So in this case, the investor will get 20 crore and the common shareholder will get 30 crore. So assuming if this non-participative liquidation preference would not have been there, then common shareholder would have got 40 crores in this case if the company was sold for 50 crore. But because of this non-participative liquidation preference, ultimately the return for common share was reduced to 30 crore, and the return for the preference shareholder increased to 20 crore instead of 10 crore. So this is how the non-participative liquidation preference also going to impact the valuation for common shares. Then we need to see what's the conversion price, what's the conversion ratio, whether it's 1:1, 1:2.5. Then the liquidation preference can also be 1x, 2x. So we have also seen situations where the liquidation preference is 2x. So basically the clause says that the investor will get it's 2x of investment amount or its proportionate stake, whichever is higher. Or it may suggest that the investor will first get 2x of its investment amount, and then the investor will participate in its liquidation, will participate proportionately in the liquidation amount. So the higher is the liquidation preference amount or the multiple, the larger its impact on the valuation. And we have seen where even the liquidation preference was 2x, 2.5x, that could be a situation. So here we have tried to work out basically explain that how the distribution waterfall will look like that for the investor. If there is no liquidation preference, so whatever is the value, so basically investor and founders, they're going to have a linear kind of payoff. But if there is 1x not participative liquidation preference, then up to a certain level, if there is no increase in the value, the investor have an edge over the founders, and then basically they will participate. In case of a participative, they have an edge over the founder over a longer period of time, and then it become more like a linear equation. In case of 2x participative, the edge remains for a long period of time. Now I will pick up one practical example here to really take you through that how the liquidation preference work, and I'll open an Excel file. So first of all, you will find such kind of clause. So we put one simple clause from a shareholder agreement to explain you that how this would be defined. So whenever you are looking into the agreement, you see you check for the liquidation preference clause. So this is the clause we have picked where the liquidation preference was non-participative. And so the clause will say that first, the holder of shares of Series B preferred stock before any payment shall be made to the holder of Series A. So Series A1, Series A common stock by reason of the ownership, therefore, an amount per share equal to the higher of 1 time of the original issue price plus any accrued dividend, or such amount as per share as would have been payable had all shares of Series B preferred stock been converted into common stock. So what this clause says that if there is any liquidation event into the company, then the liquidation amount will be distributed in the following order of priority. The Series B preferred stockholder, they will first get the payment before Series A, Series A1 common stock, which is 1 time of their investment amount, or or the value if they would have converted into common stock, which is like proportionate stake for their interest in the company, or the value for their proportionate interest in the company, whichever is higher. So first, if the payment to Series B is made, then it says that next, after the payment of Series B liquidation amount, the holder of the shares of Series A and Series A then outstanding before any payment shall be made to the holder of common stock. So now they're saying that before the payment could be made to common stock, now A1 and A would participate here, and they will get their original investment amount or their proportionate interest, value of their proportionate interest in the company, whichever is higher. And at last, whatever is left after making the liquidation amount payments to the preferred stock, whatever is remaining will be distributed to the common shareholder. So, so such kind of clause you could see into the shareholders agreement, and this is and this clause basically is a non-participative liquidation preference clause, because investor is going to get the investment amount or the proportionate stake, whichever is higher. So if you see such kind of clause into the agreement, then it's important for us to capture the impact of the liquidation preference. Now your question is that how to capture and where to capture this impact. So what we do is that we first of all calculate the value of the company using any applicable method. It could be DCF, it could be comparable company, it could be CTM, it could be mix of all three. Once we get the value of the company, then we apply the option pricing model method to allocate that value between CCPS and to the common share. So once you have identified that there is a liquidation preference clause into the company, and you have calculated the overall equity value of the company, overall value of the company, not equity value, overall value of the company. Now the time comes where we apply the option pricing method to allocate that value between the CCPS holder and the common shareholder based on their liquidation preference rights, and arrive at the value of the common share or value of the all classes of shares. This is what we do, and they're critical. There are 4 or 5 important inputs or steps what we follow for applying the option pricing model. So we'll first talk about the input. So the first input which is required is called the indicated equity value of the company. So as I told you, we first calculate the equity value using the DCF model or any other method that goes as one of the value for the entire company, entire equity value of the company. Then we need the risk-free rate, we need the volatility factor, we need the time to expiration. So here time to expiration means the estimated exit event for the company, and this we either sometime the exit events are defined in the agreement itself along with the exit timelines. So we pick it from there. If the exit timelines are not given in the shareholders agreement, then we ask from the management that typically what kind of exit period investor is looking to exit, and then we take it as time to expiration. Then we need the capital structure of the company, we need the liquidation preference clause or rights. So using these inputs, we apply a option pricing method. So I'll take you to an Excel file to really show, because explaining it on PPT, it's difficult to really explain. So as I discussed earlier, this is an example, and these figures are in USD. So most of the inputs are basically for US market. So by using like appropriate method, we work out the equity value of the company, which is assuming like 45 million in this case. Okay. The time to maturity based on discussion with the company, we found that from the valuation date, the plan to exit in 4-year period. Risk-free rate for a corresponding 4-year period, we calculate the risk-free rate, and the volatility again for the 4-year period using the volatility of the comparable company stock price, we pick that volatility. In case of option pricing model, technically we need to use the asset volatility and not the equity volatility, but I'm not going to deep dive into that concept because that's a different altogether technical concept. But here I'm just saying that we need to pick the asset volatility, which in this case we assume 50%. Now see, assuming this is a cap table of the company where the company have issued Series B preferred stock, assuming 12 million shares at $1.75, and total investment amount was say 21 million. The company also issued Series A preferred stock at 79 cents with the investment amount of 4.1 million. Then the company have common stock on its cap table, which were issued at 0 value. Then the company have granted various stock options, equity incentive plan at different exercise price, assuming exercise price of 1 cent, 23 cent, 41 cent, 42 cents. So these are the different stock options they have granted at different exercise price. So this is how the cap table look like for the company. So as a first step for applying the option pricing model to allocate the value, we need to calculate the breakpoints. So breakpoints basically refer to a milestone at which a certain decision will be taken. Okay, so it basically represent a point where the investor will decide whether it will convert or whether not to convert. So basically, not to convert, not a right way to say, but it's a milestone at which different events in the company or within the distribution waterfall are going to happen. Okay, so in this case, tranche 1. So Since the Series B preferred stockholder, they have a seniority right, because the Series B stockholder, they were saying that even before making any payment to Series A or any other common stockholder, they are going to get the investment amount back. So the first tranche is basically the liquidation preference of the Series B preferred stockholder. This will become our first tranche point. So this is the first distribution point where we will out of the total liquidation proceeds, we will pay this amount back to the Series B investor. The second tranche point is basically because the Series A, now the Series A stockholder have a liquidation preference over the common stockholder, which is equivalent to the investment amount. So the second tranche will become, so the 12 million plus the liquidation preference amount of the Series A, which was 4.5 million. So this becomes the second tranche. So up by second tranche, 25.86 million would be distributed to the investors, 21 to Series A, and 4 million to Series B broadly. Okay, this is the second tranche. Now coming to the third tranche or the third breakpoint. So this is the breakpoint where now the common share will get value up to the point where the stock options will get converted at 1 cent. So this is the level, or this is the tranche at which the stock option will convert, because the exercise price is 1 cent. So therefore up to 1 cent in this tranche, the equity shareholder will get how much value? So they will get a value of 99,000. So next 99,000 is basically distributed to the common shareholders, because now up to 1 cent, there's no one to participate. Investors have taken their liquidation preference amount, and common shareholders will get this 99,000. So how this 99,000 is calculated? So basically the common stock total number of shares multiplied by 1 cent will give this amount. So therefore, third tranche will be the total amount of the previous tranche plus the value which common shareholder will get. Now the next breakpoint will be 23 cents, because this is the breakpoint at which the second category of stock option holders will convert their shares. So therefore now from 1 cent to 23 cents, this is that, like 22 cents will be distributed to the stockholder, common shareholder, and the shareholders who converted their stock plan into the equity share. So therefore, in tranche 4, this is the tranche 4, common shareholder plus the employees who were holding stock option at 1 cent, they will get 22 cents. So this will become the tranche 4. So therefore, if you see the calculation here, 2.2 million will be distributed to the common shareholder and to the stock option holder of 1 cent. So this is how it is calculated. C8, C9, sum of C8, C9 multiplied by D10 minus D9. So this is C8 and C9. So multiplication of this 2 minus the delta of this 2. So because 1 cent has been distributed, now between the next tranche point, which is 23, so 22 cents will be distributed to these two shareholders. This is the tranche 4. Now tranche 5, which is at a 41 cent point. So what will happen now? Between 41 cent and 23 cents, which is like almost 18 cents, will be distributed to the common shareholder, the employees holding 1 cent option, 23 cents option. So next 18 cents will be distributed to all these 3 category of shares. So that will become the tranche 5. So this is how it is calculated. So if you see that the delta between this 2 tranche is 1.96. So how this 1.96 million is calculated? So this is the sum total of all these 3 multiplied by the delta, which is 18 cents. Okay, so this will become the tranche 5. Now the tranche 6 is the 42 cents. So basically in break point, what we need to calculate at different price point at which certain event is going to occur, that price point become a break point. And we need to see that, okay, up to that price point, how much amount will be distributed to different shareholders. So now what will happen at this price point of 42 cents? So since the delta is only 1 cent, so all this four will get 1 cent additional up to the 42 cents. So this is how the fifth tranche point, it was on only for 137,000, because this is only for 1 cent. Now moving to the next tranche is at 79 cents, because 79 cents is a price point at which now the Series A stockholder get a right to convert. So what happened now? Everyone from common stockholder to all the stockholder, they will effectively get 37 cents. So in the next tranche, all these shareholders will get up to 37 cents. So this all sum multiplied by 37, which is 5.5 million, will be distributed to them, which is like this is 5.5 million. Okay. And the last tranche is basically 1.75. So because at this price point, the Series B stockholder, they get the right to convert. So between 1.75 to 0.79, this price of 96 cents will be distributed to the common shareholder and Series A holder. This become the last tranche point, the second last, and the last tranche point beyond 55 million is something. Then at this price point, everyone is going to participate. So this is how we calculate the break points. And once we calculate the breakpoint, I know it's slightly complex, so and there's a lot of theory also available online. So after this session, maybe you can also read that theory, but I have tried to explain practically how it is calculated and how you can make different breakpoints. So this is step 1 for applying the option pricing model, is that you need to calculate the breakpoints. Once the breakpoint is calculated, the next step is to calculate the distribution proportion. That for each breakpoint, how different shareholders are going to participate. So for example, tranche 1 is only allocable to Series B shareholder because this is their liquidation preference side. So 100% of tranche 1 will go to the Series B shareholders. The second tranche is 100% for the Series A because this is their liquidation preference. So the second tranche of 100% will go to the Series A shareholder. Third tranche was for the common stock because here up to 1 cent, the common shareholders were participating. So therefore, up to this point, the common shareholders, 100% will go to the common shareholders. For the next tranche, which is up to the 23 cents, since the common shareholder, these two were participating. Okay. So therefore, the tranche 4 distribution, is basically between the common shareholder and the 1 cent stock option holder. So this is basically the proportion of this capital structure. This is how the distribution for tranche 4 will be calculated. The tranche 5. So tranche 5 was up to a point which was at 20, tranche 5, just a minute. Yeah, tranche 5 was there up to 23 cents. Sorry, tranche 4, we were tranche 4. So tranche 4, we discussed, yeah, tranche 5 is up to 41 cents. So therefore, they all were participating in tranche 5, common stock, 1 cent and 23 cent holder. So therefore, the tranche 5 will be distributed among these 3 shareholders. So if you see tranche 5 distribution, This is 1 cent holder, this one and this one. So in the proportion of their shareholding. Tranche 6 was up to 42 cents. So tranche 6 was among these 4 shareholders. So therefore, tranche 6, if you see the distribution waterfall, the tranche 6 is among these 4 in the proportion of their distribution waterfall, in the proportion of their shareholding pattern. In the tranche 5, all the all the common and this were participating. So therefore, this tranche 7 will be to all the common stockholder, including the stock option holder. Tranche 8, which was up to 0.175, and this is a tranche at which Series A also participated. So therefore, here the Series A will participate. So all these percentages have been calculated based on the number of shares held by each category of the class. So how this 25.8 was calculated was basically common Series A, which is 25.2 million, sum of all the number of shares up to this level. So this is 25.81. This is how it is calculated here, 25.8. And tranche 9, where all will participate. So this is basically represent the fully diluted shareholding pattern. So this is how, like, this is step 2. Step 1, we calculated the breakpoint. Step 2, we calculated the distribution waterfall. Then here is the step 3, where we calculate the option value using the BS model. So here what we do, again, these are the 5 major inputs: stock price, exercise price, maturity period, RF, and standard deviation. These inputs we pick from here. Like initially we take maturity period of 4 years, risk period of 2.86, volatility of 50%. So this inputs came here. Now what happens? Stock price is the value of the company, what we have calculated initially, 45 million, using different methods. Now here each tranche is an option, will become an option. So therefore the exercise price is basically the starting point of the breakpoint. So if you see here, the starting point of the breakpoint become the exercise price for each tranche. So this is 0. This is 21.7 million, which is the starting point for breakpoint 2. Then for third tranche, the exercise price is the starting point for tranche 3. For tranche 4, this is the starting point. So the breakpoint which we calculated, the starting point really become an exercise price for BS model. And for 9 tranches, we calculate the option value, call option value. So this is the call option value which is getting calculated for each tranche. So for tranche 1, the option value is 45 million. For tranche 2, option value is 29 million. For tranche 3, option value is 27 million. So this is the option value for each tranche. Now this is step 3. Once we get this option value, then we plot this option values again is each tranche here. Like if you see the opening value and the ending value. Okay. So this is why I would say the mathematically driven process, step by step, we have to follow these steps. And since it's a statistical driven, if you're going to ask me why this is done, why we are doing all these steps. So this is, since it's a statistical driven model, I'm not going to really explain why all those steps are being done, but I'm explaining the different steps and procedures you need to follow. So once we calculate the option value, okay, against each tranche, then we plot those option values. So the opening value and the ending value for each tranche. So opening value become the 45 million. So the tranche 1 opening value is 45 million, and the sorry, tranche 1 ending value is basically the value for tranche 2. It become the ending value. So opening value for tranche 2 is the value for tranche 2 itself, and the ending value is basically the value for tranche 3. So this is how we plot this value, and we calculate the delta between these values. Okay, so this is the difference between these two. So this is step 5. So I'll again repeat. Step 1, calculate the breakpoints. Step 2, calculate the distribution waterfall. Step 3, calculate the option values. Step 4, put the option values against each tranche points. Step 5, calculate the distribution waterfall. Oh, sorry, calculate the delta of each option value at each tranche. Now, once we calculate this delta, we distribute based on the distribution proportion, which we calculated earlier. So for example, tranche 1 option value delta will be allocated entirely to series A. Tranche 2 to series B, series B here, series A here. Tranche 3 to common stock. Tranche 4 delta of option value will be to common stock and to equity incentive plan. This is how you can see here. The tranche value 100% got to series B. This is to series A. This is to A and B. So if you see here, tranche 8, this got allocated between A and the common shareholders, and this is to all. So after doing this thing, and when we sum total, now this is how the 45 million got allocated to different classes of shares. So 45 million out of 45 million, 22 million got allocated to series B, 6.5 million allocated to series A. And 11 million got allocated to common share. And if we divide by the number of units, we effectively get the value per unit. And you can see here the delta. The series B value is 1.82 and common stock value is 1.16. So it's a significant delta between the two. And this delta is primarily because of the liquidation preference. So if we would have simply divided the common share, the value by the fully diluted base. So you see here. So this is the total value which we had calculated for the company. So if we would have just divided this value by the total number of company share on a fully diluted basis, we would have end up a fully diluted value of $1.39. Whereas the value what we got for common share after doing this entire process, after allocating the value over different classes using liquidation preference, we were getting a value of 1.16. So this is the importance of this method and importance of liquidation preference, that if we would have picked 1.39 as an input in our BS model, we would have overstated the value of stock options and we would have ignored the impact of liquidation preference in this case. So this is how the liquidation preference is being applied. Just one last input here is that the value what we get here applying this basically gives a value on a non-controlling marketable base. And generally, especially in case of a unlisted company, when we calculate the equity share value as an input into the BS model for valuing the stock option, we also apply a discount for lack of marketability factor to this value, because like this is a value which the company would get on the sale of the company, and this is a value which is allocable to the majority shareholder. But employees effectively, even if they exercise their right, they are going to get only a fractional percentage into a company on the cap table, a very small number of shares or small percentage of interest into the company, and it's difficult to find a hypothetical or actual buyer for the same. So therefore we apply a discount for the same, assuming that since it would be difficult to get the liquidity of the underlying common share. So because this price is at a marketable basis, we applied discount for lack of marketability to arrive at a price which is non-marketable, which is adjusted for illiquidity, and then use it as an input into the BS model. So there is a technical method which you can adopt, which is called the Schaffe model protective put option model to calculate the DeLong. So you can search and find. So this is called Schaffe model protective put option model. So this model is generally used to calculate the DeLong factor. So in this case, we use the inputs, which is like common price, share price, exercise price, and all other option, and we calculate the put premium. That put premium divided by the value of the company give us the implied discount. So basically what this model suggests that if the holder needs to protect its value upon liquidity, so the holder will enter into a hypothetical put option where based on the current price of the company today, they will buy a put option where they get a right to sell the shares at the same price. So if they acquire a put option, ultimately they basically ensure a liquidity at the same price. But to buy this hypothetical put option, they have to pay a put premium. So that put premium is basically the cost to to get that liquidity. And this is how this put option model is being used to calculate the DeLong. And so after adjusting the DeLong, we get the non-controlling, non-marketable value, and this value is ultimately used in the BS model. So this is how we apply this BS model. I know this is quite technical, and I put my best effort to try to explain you step by step, so that you get some understanding on the same. And as I told you, there's a lot of material available online, which you can go through to further get a in-depth understanding of this model. So this is from my side. And with this, I'd like to conclude the presentation. Now I'll open the open for discussion, and if any questions, happy to answer those questions. And with this, I'd like to hand it over to Shruti to see if there's any questions there.
Thank you so much, sir. Yes, there are a couple of questions. So I'll ask. In case of SAR with cash alternative, shall company require to value the SAR or difference shall be based on FMV of equity shares?
So SARs will be calculated using the appropriate option pricing model. So we just can't use the difference between the two, because that's an intrinsic value. Yeah.
So next question is, why is implied volatility preferable while applying the BS model in place of the historical price volatility?
So basically here the vol means that what is the expected increase and decrease we are assuming. So that we have to see on a forward-looking basis. So like on a forward-looking basis, how the price could fluctuate up and down. So therefore the implied is a better benchmark, which is a forward-looking. But since we do not get the implied volatility for the unlisted company, we used historical vol as a benchmark. So we use the historical trend as a proxy for the future trend, basically.
When a company goes for an IPO, generally the valuation they ask in IPO is significantly different from the valuation of the company used to value ESOPs, which were offered, say 6 months back from IPO date. How these two different valuations are derived in a short span of time?
See, the IPO price is always the market, based upon the market price, book building and other aspects which is there. So if you are doing a valuation which is before the IPO date, then you are applying the fundamental techniques to value this, and that fundamental value may or may not equal to IPO price. So this is, I would say, the practical situation which we need to handle when the situation comes. So if we know that the IPO, that the management is planning for IPO, then we check with them if there's any indication they get about the estimated price they could get in the market from the merchant bankers. Then when we do fundamental value, we try to arrive at a value which is closer to that value to the extent possible. I'm not say that we arrive at that value itself, but again, like if the delta is of 6 months and we do not have any indication at which the IPO is expected to come, then do your best to arrive at the fundamental value, and whatever the fundamental value you have calculated, you should be able to defend that value irrespective of the IPO price after 6 months.
Thank you so much, sir. It's a great learning session. So as we conclude this session, we extend a sincere thanks to our distinguished speaker, CA Amrish Gargji, for his valuable insights. It was an enriching experience, sir. We also express our gratitude to our chairman, CA Hansraj Chugji, a vice chairperson, CA Preeti Savla ma'am, and the entire support team of ICAI. We would like to acknowledge and appreciate our audience for dedicating your valuable time and for your active participation. We are eager to meet you again in our upcoming sessions. Thank you so much. Have a wonderful day ahead. Thank you.
Thank you, everyone. Thank you.